Hey everyone, it's Jay, and today we're diving into a topic that's been generating a lot of buzz lately, especially among younger investors like yourselves, alternative investments. You see it everywhere. From that billboard pitching you on farmland, to that Instagram ad for a fractional share of a Picasso, it seems like everyone's looking beyond the usual stocks and bonds. And hey, I get it. The idea of diversifying your portfolio with something a little more tangible, a little more exciting, it's pretty appealing. But before you jump in head first, it's crucial to understand both the potential benefits and the risks that come with these investments. So, in this video, we're going to break down 3 popular alternative assets: gold, real estate, and fractional investments. We'll explore what makes them tick, the pros and cons, and everything in between. Let's kick things off with one of the oldest alternative investments in the book: gold. For centuries, gold has been seen as this ultimate store of value, a safe haven during times of economic uncertainty. Remember the 2008 financial crisis? Gold prices skyrocketed. Why? Because when the market's going haywire, people get scared, and they flock to assets they perceive as stable, like good old shiny gold. Plus, gold is a tangible asset. You can hold it in your hand, which for some investors provides a sense of security that a stock certificate just can't match. It's a hedge against inflation too. As the value of currency fluctuates, gold has historically held its purchasing power pretty well. But, and this is a big but, gold doesn't generate any cash flow. Unlike a dividend-paying stock or a rental property, gold just sits there, appreciating, hopefully, in value over time. And speaking of appreciation, gold prices can be incredibly volatile. Remember that spike during the financial crisis? Well, after reaching record highs, gold prices tumbled back down and have been fluctuating ever since. So, while gold can be a good hedge against inflation and economic uncertainty, it's definitely not a get-rich-quick scheme. It's a long-term play, and you need to be comfortable with its volatility. Next up, we have real estate, one of the most popular alternative investments out there, and for good reason. Unlike gold, real estate can generate passive income. Buy a rental property, find a tenant, and boom, you've got a consistent stream of cash flow coming in every month. And that's not all. Real estate also has the potential for appreciation. As cities grow and demand for housing increases, the value of your property can go up, allowing you to build equity over time. Plus, there are some sweet tax advantages that come with owning real estate, like deductions for mortgage interest and property taxes. But hold your horses. Real estate isn't without its risks. First off, it requires a significant upfront investment. We're talking down payment, closing costs, and don't forget about those unexpected repairs that always seem to pop up. Then there's the whole being a landlord thing. Dealing with tenants, handling maintenance requests, chasing down late rent payments, it can be a real headache. And let's not forget about market fluctuations. Just like any investment, real estate prices can go down, leaving you with a property worth less than what you paid for it. So while real estate offers the potential for passive income, appreciation, and tax benefits, it's crucial to carefully consider the risks and responsibilities involved before diving in. Chapter 3. Fractional Investments, Owning a Slice of the Pie. Finally, let's talk about fractional investments, the new kid on the block that's making alternative assets more accessible than ever. Essentially, fractional investing allows you to buy a small piece of a larger asset, like a piece of real estate, a rare painting, or even a vintage sports car. Think of it like buying a slice of pizza instead of the whole pie. You get a taste of the action without having to fork over a fortune. This is huge for younger investors who might not have hundreds of thousands of dollars lying around to buy a rental property or a Warhol. Plus, fractional investing platforms often handle all the messy stuff, like property management or art storage, making it a relatively hands-off investment. But, and this is important, fractional investments are still relatively new, and with that comes uncertainty. The platforms themselves are still figuring things out, and regulations are evolving. Liquidity can also be an issue. Selling your fractional share might not be as easy as selling a stock or bond, especially if there's limited demand for the underlying asset. And just like any investment, fractional investments come with risks. The value of the underlying asset can go down, and there's always the possibility of fraud or mismanagement by the platform. So, there you have it, a glimpse into the world of alternative investments. We've covered the potential for gold to hedge against inflation, the passive income and appreciation possibilities of real estate, and the accessibility of fractional investments. Remember, diversification is key to a well-rounded portfolio, and alternative assets can play a role in that. But before you jump in, do your own research, understand the risks involved, and make sure it aligns with your overall investment goals and risk tolerance. If you found this video helpful, be sure to give it a thumbs up, subscribe to the channel for more financial tips and tricks, and let me know in the comments what other alternative investments you're curious about. See you in the next one.